HBM in their design decisions, or these specific optical cables, or a whole bunch of other things, you're going to be in a really difficult spot because Nvidia has bought them all. You went to another country. Where'd you go this week? I was in Paris, France. What were you doing there? There's an important AI conference and Jonathan Ross, the founder of Grok, and I kicked it off with a fireside chat for about 45 minutes at the beginning just to get everybody amped up and excited. Cool. How did it go? Yeah, it was really good. One thing that stood out to me was a soundbite from Jonathan. I think he did a very good job explaining where Nvidia is really strong, particularly in learning, and where Nvidia is trying to build their business, which is in inference. But the problem is, the features almost compete with each other between learning and inference, and I thought that was a great clarification. The second thing he mentioned was that if he deploys his roadmap, he'll have 50% of the available inference compute by the end of next year. Wow! Based on all the needs of OpenAI, Meta, and everyone else. That's impressive. And it has a smaller physical footprint, right? Exactly, and it's because they can do higher tokens per second with less power across all the major models, making it meaningfully cheaper as well. That was a pretty amazing soundbite. His whole explanation was great, so I'm trying to get a copy of the talk. It was recorded, and I hope we can post it. Anyone interested in studying Nvidia should listen to what he has to say, because the nuances between us and them are really profound. It was stark the way he described them, which was cool. And it was great to be in Paris, frankly. How does Nvidia respond to this movement, or the notion of an entirely different chip category focused purely on inference? Do they have inference-focused chips in development, or a separate roadmap they'll need to prioritize now? I think it's really hard for them. It's a structural innovator's dilemma. Why is that? Because they've made architectural decisions around things like HBM, which is high bandwidth memory, or specific kinds of high-throughput optical cables. They bought up the global supply and cornered those markets as a structural part of their design. It's very strategic and legal. But if you design around that and go through an entirely orthogonal process, we're not subject to any of those supply chain constraints, and I think he explained that well. I didn't fully understand it before, but I did after. This is important for the hundreds of chip startups and the venture investors pouring money into these companies who need to know these differences. If you're investing in a company that depends on HBM for design decisions, or specific optical cables, or other constrained resources, you're going to be in a tough spot because Nvidia has bought them all. That was really interesting to me. Another thing Nvidia does brilliantly is what Intel did in the 80s and 90s when they wanted to choke CPU competition. They defined a metric everyone started to care about, like clock speed. If you remember, Intel pushed Moore's law, transistor density, and clock speed as metrics of value. For many consumers, we didn't know better, so we go through the Pentium upgrade cycle thinking it was necessary. But clock speed doesn't impact speed in the way users experience it with software. It's similar in AI, and we talked about that too. Nvidia is an incredibly important company. They're performing brilliantly, running the same plays Intel did to create dominance. But there are important nuances around power, supply chain decisions, and technology decisions that some might view as unsustainable. I'd be in that camp the more I understand it. It was an important conversation, and hopefully, we can post it. Why did we start off with Amazon? What did you think of what you saw there? I thought it was interesting. Cloud actually missed estimates, but we're seeing the stock move higher. Yeah, Amazon had a few blemishes, and after yesterday, you might think everything would get punished. But not Amazon, apparently. I think the profitability was the big surprise of the quarter, with a lot of it on the bottom line. That gives investors comfort. The sales numbers were close, so it's no surprise the stock is up. It hasn't been a top performer in the Magnificent Seven of tech stocks, so there's some room for it to grow. We've seen increased capex by 81%, and at the same time, we saw margin expansion. That's tough to pull off. It really is, and the capex number is important. Now that we're past the big capex spenders, you see all cloud spenders focusing on capex and spending large sums. Jassy's comments on AI, generative AI, and their focus on it mean that story will continue, which is good news for Nvidia, which will be the last of the Magnificent Seven to report. Let's discuss Apple quickly. Those shares are down just over 1% right now, mostly due to guidance concerns. There were other positive points in the report. According to Deepwater's Gene Munster, the guidance suggested 4 to 6% revenue growth, but the street expected nearly 7%. That explains the stock's 1% drop, even with good news on iPhone sales and a 6% increase. Apple has had a strong run this year due to iPhone 16 and AI. Both were somewhat underwhelming in functionality, though iPhone sales were decent. That was better than feared from my perspective. And since the stock hasn't performed well recently, a 1% decline is relatively mild, considering there's still more to come with the iPhone 16. True, but given its weight in the market, it's significant. Let's talk about Apple's forward P/E at 31 times. Is this dip a sign that investors are paying more attention to forward P/E valuations? Does this hint at what we might see for the rest of earnings season? That's what we saw yesterday. It's typical when the market nears all-time highs and P/E multiples hit the mid-20s. You're priced for perfection. When results miss expectations, even slightly, the market reacts, as we saw yesterday. None of the news was terrible across the board, just a bit less than expected. In a market based on strong growth and earnings, that can prompt repositioning. This version addresses grammatical issues while keeping the length and essence of the script the same. Let me know if there's anything specific you'd like further adjusted. Appears enough real. Enough smoke is present to indicate that there is a fire. Others in the supply chain have confirmed it to us, and Supermicro made reference to it, so it appears to be genuine. It appears to be a minor design flaw rather than a serious one. It appears like they may have already resolved the issue. We may be delayed by 2 to 3 months. In actuality, this implies that those who were expecting actual volume shipments in calendar Q4 may instead see them in Q1. It's a minor push-out. Keep in mind that even Nvidia is not immune to this kind of difficulty. Hyperscale CapEx recommendations that are still increasing have taken this problem into account in the interim. Hopper, Nvidia's current design, is in high demand, and it appears that the company is stepping up production to tide things over until Blackwell, perhaps a quarter later, emerges in volume. I do not believe it to be a major structural problem. It's obvious that sentiment has affected the stock. Several factors have affected the stock, including a broad decline in attitude toward AI as people start to doubt ROI. Additionally, it is burdened by this problem. However, I don't believe Nvidia has changed structurally. We had a slight push-out, but I believe everything will work out. As you say, there is still demand. What about the stock itself? How enticing is it given its multiple? Even at its height, Nvidia was around 40 times projected profits, and the sell-side figures are probably too low. The company has never been that costly. It's actually not that expensive. 40 times is roughly its 5-year median. It's likely 30 times forward now. Even if it